Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX Capital, and welcome to our webinar. Now, for those of you that are joining us for the first time, ETX is a regulated provider, and therefore I'm required to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments of any kind. All securities that we talk about tonight are for educational purposes only. Now, for those of you who just don't know much about ETX, we are a fast-growing financial services company, and we are based in London. You can come by our offices and see us. And we are authorized by the FCA, the Financial Conduct Authority. We have a broad global client base, and we're a member firm of the London Stock Exchange. Somebody just wrote in before we get started saying, how do they speak to me? This is not a two-way conversation. This is a webinar. It's a lecture. We're not having open mic night tonight, so you can sit back and enjoy the webinar. If you want to be here for a conversation, we won't be having any. So sit back and relax and listen to the lecture on The Trend is Your Friend. Now, tonight we're going to be discussing trend lines. And trend lines are a crucially important part of what's called technical analysis. Now, learning how to read a Forex chart is considered to be somewhat of a science. They look complicated at first glance. The Forex charts can look drastically different depending on what options you use. Charts usually have settings for display style of the price and the time frame you want to view. Time frames can be anywhere from 1 second to 10 years, depending on what charting system. Price can usually be displayed as a candlestick, a line, or a bar. So if you don't understand the basics of charting, every month we have a class called Charting Basics, and you should come to that. And we'll teach you the differences between the charts and how to properly use your charts. Because in order to do any technical analysis, you have to understand, you have to use a chart. All technical analysis is basically done on a chart. It's the visual depiction of price. And a chart is a graphical description of Forex price movement over a specific time period. Now, we have 3 types of charts: the line chart, the bar chart, and the candlestick chart. All the other charts out there, and there's lots of different, are just variations of these 3 main types of charts. Okay, but the best chart to use, especially for your beginning technical analysis, is a bar chart. Only because a bar chart gives you a lot of information in an easy to see fashion on a chart. It shows you the open, the high, the low, and the close for each time period. Okay. And again, we go into greater detail in the Charting Basics class. Tonight, for learning how to draw trend lines, you have to learn how to use a chart to properly draw these trend lines on there. But trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There are a lot of myths and inaccurate information about trend lines, though. Learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into the common mistakes and traps. Trend lines are a technical analysis tool used to define and project price trends in a major market such as stocks, Forex, and commodity futures. Trend lines have the potential to alert us when a pullback, a move against the trend direction, is over and the trend is resuming, or when a trend is accelerating or reversing. Price is the ultimate indicator, though. Therefore, price action must always be considered when using trend lines. Now, trend lines are drawn on charts to help predict the general direction of price. They also help you see reversals. Trend lines also help you determine good entry and exit points and will help you decide where to put your stops. Wow, they sound like magic lines, right? Well, not really. They are quite good, but like any other form of analysis, if used alone, they won't make you many pips. However, they are a great addition to your trading arsenal. Now, trend lines, as well as support and resistance lines and volume, should always be on your charts, no matter what your trading system you're using, what strategy you're using. These three pieces are your crucial roadmap to success. Whether you do anything more on a chart, these three pieces of information are crucially important. Now, trend lines are very important about how you place them on your chart. It can be a little intimidating to start, but it is quite easy once you get a hang of it. Now, the thing is, trend lines are not a secret weapon. They're not something unique to you, and you're not going to create your own trend line, your own system. Because what a trend line does is it follows specific rules to put a properly validated active trend line on a chart. When you put this on a chart, you're putting the same line on your chart that a million other traders are using. And by doing this, you now know where price should have an action. So if you draw your trend line incorrectly, you're waiting to see some type of response at the wrong price. So you want to know and learn how to draw your trend lines properly, following the rules, because when you can predict that price should have an action, and we're not saying it's going to bounce off the trend line or go through the trend line, but traders tend to hem and haw when crucial points or crucial prices are happening, because price doesn't move in a straight line. It bounces up and down, up and down. When it starts approaching the trend line, we can expect it to bounce off of it, or if it breaks through, then we have to create a new trend line. But you're expecting some type of action at a specific line, like on the chart you're looking at, and it's unimportant the asset or the price. We have an active trend line. That means it's a valid trend line, and it's fit the rules. So when price hit here at that price and hit on the trend line, we were expecting it to bounce off of there. It could have broken through, but you can see that this trend line is supporting price, and price should always move in thrust and ease, thrust and ease, thrust and ease, and the ease part should never come down below the trend line. And it then helps you understand the market psychology, or what is going on in the markets and where traders are headed. A trend line doesn't really give you hardcore entry points or exit points. It doesn't tell you anything. It warns you. Now, there are two main types of trend lines. There are bullish trend lines and bearish trend lines. In other words, the ones that go up and the ones that go down. So when we discuss these, they are just the reverse. If the trend is moving down, you just reverse what we're talking about. If the trend is moving up, you follow this. A trend line is always drawn underneath the prices in an uptrend. In a downtrend, it's drawn over top of the prices, because a trend line serves as a support line. It holds up those prices. In a downtrend, it's supporting the move down. Okay. So as you can see here, we have a bullish trend line, and it's drawn by connecting swing low points. Okay. And we'll go on to the rules in a second. So that was a bullish trend line, and here we have a bearish trend line, which is, as you can see, just the opposite. It's drawn over top of the prices. Now, drawing a trend line isn't complicated. It's just that you would tend to try to make it more complicated, or you'll try to make it fit your own rules or where you think it should be, because you can visually see a trend on a trend line or a trend in prices, and you're going to try to connect those points to be crucial. So the basics are, you want to identify a trend line by drawing a line between two swing lows or two swing highs. Now, in an uptrend, you're drawing it between the swing lows. In the downtrend, you're drawing above the swing highs. What that means is the swing high or the swing low is the highest or lowest point that price hit before the new trend started. And then as the price is moving in that direction, it's the lowest point it has touched since. Okay. And you simply draw a line between them. So as we can see on this chart, okay, this was the swing low. As you notice, we were in a downtrend. This is where the downtrend reversed and started moving up. So this is considered the swing low. It's the lowest point the price made when moving into the uptrend, okay, or the lowest price that the asset had fallen to. Then we draw a line connecting a minimum of 2 swing lows, because you have to have 2 points in common. And none of the points that you're connecting together could have fallen below the trend line. Now, I say 2 because that's only the starting point. Because 2 is where you can draw a trend line, but it isn't an active, valid trend until you have 3 points in common. The price must have touched that line 3 times to be considered an active, good trend line. So you draw it with 2, and you can push it out in the future, and you're going to wait for price to touch it. And it's just the opposite in a downtrend. Now, there you have it. Now your chart has a trend line on it. But wait a minute. Even though you can place a trend line based on 2 swing lows or 2 swing highs, the trend line remains unconfirmed until it hits a third time. Once a trend line is placed and it has a third bounce, it becomes active. Now the price should find support or resistance at that trend line. It should have a trouble breaking that line. If the price does break that line, it usually means that the trend is over. And then you would be drawing a reversing trend line from that point forward. So on this chart, you can see that we've drawn a trend line. We have swing lows here, and when we projected that price out farther, we had the third swing low, which is then telling us that that trend line is now active and confirmed, and we can now use it to predict price movement in the future. In the right-hand chart, we can see the same price movement is exactly the same. We have the third confirmation. Price bounced off there, moved up. Then it came back down to trend line. In this case, it broke through the trend line, and it was the end of the bullish trend line. Now, we need the 3 points to confirm it. And each time when price bounced off of there, we saw it go up. When it came back down, we didn't know whether it was going to bounce off or go back up. Once it breaks it, it'll be telling you the trend is over. And then you can see it moved into a downtrend, or it can move into a period of consolidation. But trend lines can be placed on any time frame, but they're more effective on longer time frames. Also, the longer the trend line is active, the stronger it gets. The more times you've seen price come down to that trend line and bounce off of it, the more significant that trend line is. Okay, and the more important that trend line will serve in your future price prediction. So, unfortunately, a lot of traders want to draw a trend line based on what they think it should be. So if we look at the chart on the left with the big red X, we see we had a swing low here. Traders saw a swing low here, and they wanted, because it looked better visually, to draw that trend line. And they want to ignore this. But you can't do that, because when you ignore that, okay, at this point, this trend was no longer valid. Now, when it bounced up, you could have had a new swing low here and a new trend line, but you could not ignore the breakthrough, because this is becoming a downtrend. Then you could have drawn a new uptrend using this swing low and that swing low. Okay. The correct way to draw that original trend line on your chart would have been from this point using this swing low here and projecting it out to the future here. Now, yes, it might look nicer here. You might say, okay, in my strategy, I'm going to use it here. But what happens is the market isn't going to react to the prices on your trend line. They're going to react to the prices on the correct trend line. Because when 1 million people are you drawing the same trend line the same way, what's it tell you about the market psychology? Trend lines aren't for you to have a secret weapon. You have other strategies for that. Trend lines are to let you know exactly what is going on out there. So let's go over 3 basic tips. Tip 1, we want to draw a line connecting either 2 swing lows or 2 swing highs. For those unfamiliar with the term swing lows or swing highs, we simply mean the peaks and the valleys created with zigzag prices. Once we connect the peaks with other peaks or the valleys with other valleys, we want to see that the line not being broken by any candle or any bar between those 2 points. Now, part 2 or tip 2, you probably noticed that I have referenced 2 or more highs or lows. The reason I mention or more is because trend lines can continue to be relevant far out in the future and can be bounced off of several times. As a general rule of thumb, the more times a trend line is hit and respected with a bounce, the more important the market believes it is. Like anything, however, trend lines cannot last forever. So after a multitude of bounces, one has to expect a break to eventually occur. So when you're using odds and probability, the more times price bounces off that trend line, statistically, the more likely or the less likely it is to bounce the next time, it's probably going to break through because the markets move in cycles, and sooner or later that trend line is going to end. The reason for this is true that if you can draw a line connecting any 2 points on a chart, just because they were 2 distinct highs in the last 50 days and you drew a line between them doesn't mean the line is a valid trend line. What you would have is a potential trend line. Now, each time you see the price bounce off the same trend line, the more likely that others are watching it too and playing the same game you are. This could help you get several good entries in a row, but remember, trend lines won't last forever. So you want to make sure that you set proper stops to get out quickly if the support and resistance trend lines eventually fail. So tip number 3 is remember, the trend is your friend. You do not want to go or buy or trade against a trend. Statistically, you will make more pips and make more favorable trades when you trade with the trend than trying to trade against a trend. What this means is when you're in an uptrend, I'm just trying to get my marker back on here. When you're in an uptrend, you want to buy when you have reason to buy. You don't want to sell down into the trend line because we have no idea where the peaks are and where you would be selling off to. Now, yes, you could make some good trades selling in a downtrend, in an uptrend, but statistically, you will make more pips buying into an uptrend. So maybe in trying to trade against it, you'll make 50 pips. You probably would have made 200 pips selling into it, buying into it. Again, when you're in a downtrend, you would want to sell off of the touching of the trend line and get out of the market when it's appropriate using other signals, but you don't want to buy in because we have no idea if the price is going to come up to that trend line or dilly-dally and just go sideways. So in a downtrend, you always want to be selling. In an uptrend, you only want to be buying. Okay, and that's why the old adage that's been around for 100 years, the trend is your friend. Okay. Trading only in the direction of the trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't always give you winning trades, the trades that are winners will give you more pips than if you attempted to trade against a trend. Coming full circle, trend lines are very simple tools to use. You are connecting dots on a chart, but hopefully the 3 tips above, or that I provided you, will get you drawing trend lines to the next level. Make sure that the lines you draw are connecting 2 or more high points and have not been broken by the price between those points. Remember to look for a third bounce to validate a trend line. Also make sure you are taking advantage of trading with the trend by looking for buys in bullish markets and sell in bearish markets. I'm sorry, my markers just don't want to come off tonight. So whether you use trend lines or indicators, price action is what ultimately determines how much money we make. Learning about price action, how trends move, is never a bad idea. Once we understand the basic concept of how price moves, then trend lines become a more effective tool in helping us analyze that price action. Price constantly moves up and down, even within a trend. While most traders know this, they have a hard time applying that knowledge in real time. Traders often wait too long before entering, buying near the tops of a price wave, panicking as the price pulls back, and selling at the exact time they should be considered buying. Trend lines, discussed later, we're going to continue, we're going to go over look at the charts, can help in this regard. So let's go over to some live charts, and let's create together some real trend lines on some real live charts. So hold on, I've got some charts pulled up here for us. Okay, so we're going to be looking at, just because this is where I stopped before class, but you can see on here I've already drawn our trend lines. This is the British pound in a 1-hour chart. In today's chart, this is current up to the moment action. Okay. Now, let me remove all my other indicators because this is part of a trading strategy, not just trend lines. And let's get rid of the moving average lines. And let's get rid of the Fibonacci's. Okay, now we have trend lines. Now the dark red, or the bright red down here below, is a current accurate trend line. You notice where price dipped down and reversed, that gives us a swing low. We projected it out into the future. We have another swing low here, another swing low here. So we actually have a valid active trend line, and we can see all the way up here where price bounced off of that trend line down here at 124.018. I'm just trying to get my marker back on here for you. Right here, and bounced off of there. It touched that trend line and bounced straight off of that trend line. Now, there is a secondary way to use trend lines, because I've been lecturing you all night about drawing trend lines under the price when price is moving up and over the price when price is moving down. Okay. In this case, it's a basically very weak uptrend. So that's why we drew the prices underneath the price movement. Now, we can draw what is called a channel, and then we would draw so we have a support trend line here, and we have a resistance trend line that we drew above, and actually is helping us form a triangle, which is all part of understanding trends and support and resistance, which in another class we have called, what do we call them? Chart patterns and trend patterns. But we can actually see this price moving into a triangle by using the descending resistance line above and our trend line that we drew below. Okay, so let's go over here to oil. Okay, so this is a price of oil today. This is a bar chart, simple basic chart. This is oil in 30 minutes. Okay. Now we want to draw our trend lines. Now, our eye would tell us, well, here we have a pretty good trend line. That's following price, correct? Okay. Well, if you want to eyeball and say that's where price is going, okay, then you have a trend. But it's not an important trend line because it's not telling you any information, because the trend line you would properly draw by coming up here and clicking on your trend line to draw it, we would go here to the swing low, and we can't ignore this low. So that is where we would have to draw this trend line. Now, the fact is you can have what's called long-term, medium-term, and short-term trend lines. So even though this is the correct trend line, it depends on how you're trading. So in this trend line, you could have a medium-term or shorter-term uptrend or downtrend. So we could technically have a secondary trend line that we would take this swing low and call that a secondary trend line or a shorter term trend line. So this would tell us that when price is moving down, it might have some reaction right here at 54.11 if it came down to that price. Because you can have other trend lines, or you could have a different time frame trend line. So we could go to a 15-minute trend line, and we can see that I use multiple time frames to see if my trend lines still remain valid. Okay. And both of these trend lines, and especially the secondary one, is an actual very good trend line, because you see if we took this trend line off here, if we came to a chart in a 15-minute chart, we would consider this to swing low right here, and we would have drawn this trend line because we wouldn't have been looking all the way back here to that, because here we had we went into an uptrend and then a consolidated action and a short-term downtrend. So we would be using this swing low and projecting it out to there. And so therefore, by using a different time frame, you can then validate that trend line, and you still don't have an active trend line because you don't have a third point in common. But this is how you would properly draw your trend line on there. So you would have a longer term trend line, which probably wouldn't have any validity. It wouldn't have any validity in short-term trading. But this would have been where we would have coming out in that other chart and going up, and we would have been down here. And one of the best ways to verify your trend line is by using multiple time frames. If your trend line holds up in each of the time frames, because the price doesn't change in the time frames, just the bar that's telling you the story, because when we're looking at a 30-minute chart, that bar contains everything that happened in 30 minutes. When you're looking at a 1-hour chart, that bar still has the same thing, but in 1 hour, it's like it could have been a lot higher or a lot lower. Okay, so therefore, we can verify or validate, not validate, because you can't validate till you have 3 points in common, but you could verify that you were on the right course. You had a right trend line. Because like I said, this trend line is not active until you have at least the third point in common. So it means you can't use it to predict anything up until that point. We're here with the pound. Let's get rid of this line here. Here with the pound, we actually have a significantly important trend line that we have 1, 2, 3, 4 approaches on, and it is still very valid. Now, technically, you could have had other trend lines, because originally probably, it's hard to go back in time, but you might have originally drawn your trend line here. But once price broke through there, that trend line is over and done with, so you'd have to find your new trend line to move forward using this swing low, pulling it out forward there. But you could have had a short-term trend line here. This is just a garbled mess. You could have had a short-term trend line here in an uptrend. Okay. You could have had even a smaller short. You'd have to find the points in common, but you would get this by, this is a 1-hour chart. If we move this to a 15-minute chart, Come on, why aren't you changing? There we go. Okay. Then we would be looking at, because all that does is gives you more intensity. It just magnifies what you're looking at. But then you would have a short-term trend line here that you probably would have gotten a valid point. But once it broke above here, it was no longer valid. But here you would have had a short-term downtrend. But so they're not difficult to draw on a chart. Getting them to fit the rules and have significant meaning to you as well as other people is very, very important. Because you want to know what price has meaning. So if we look at this original trend line, we would have been looking when price was dipping down here. We had this trend line out here. We were looking and waiting for some type of reaction right here at the 124.013 level. We got that reaction. It bounced off of there. So that told you it was going to hold on to its upward trend line and continue moving up. Like I said, this is a horrible basic movement. It's a very weak trend. But we have a general uptrend here. And if you would have bought price down here, you would have made profit. But at this point, we're expecting now the price to bounce off of there. You're also noticing in here that price moved in a push. Price pushed, eased, pushed, eased, pushed, eased, pushed, eased. Now, there is a whole school of thought about each time that price pushes up and eases back down, it can't come below where the low was before. Okay, so in this case, you have, like I said, this is called a weak trend. It's not a very strong determinant trend. Okay, but you're still going to trade in that. You're not going to never trade. So you still draw your trend line the same way. But this is how you do it. Now, if we switch this chart over, and the reason I like using a bar chart is you don't have all this mess with the colors. Let's put this in a bar chart, and I'm just going to make the price line a little bit thicker for us. Okay, why didn't it save my colors here? Okay, so when you're using a bar chart, you don't have all the colors and all the little wicks and stuff from a candle. You can see these lines a little bit better. And the nice thing is I find drawing a trend line a lot easier to use on a bar chart. And then you can just click it back over to be a candlestick if you're using candlesticks. But it's just a cleaner way to see numbers and lines in common while you're drawing your trend line on there, and then click it back over to your candles. And if you notice here, I started out with a bar chart. So this is about the best I can show you about how to draw them. Let's go over and let's go back to my PowerPoint and cover a few little things before we wrap up the class. So hold on, let me pop up my PowerPoint in front of you. Okay, so trend lines tend to operate as a series of gradual moves high and move lows. Thus, an uptrend is a series of escalating highs and lows, while a downtrend is a series of descending lows and highs. So in the figure above is an example of an uptrend. For this to remain an uptrend, each successive low must not fall below the previous lowest point or the trend line. If it does, it is deemed a reversal. So in other words, price moves in the thrust, ease, thrust, ease, thrust, ease, and if it breaks down here, it becomes a reversal. But what we're looking for in an easily tradable trend is this slope and this action and reaction, or the peaks and the valleys. Okay. As we were looking on the charts and the live charts, you don't always get what you're looking for, but this is a very pretty view of what a trend line should be. Now, one of the best reasons to learn how to read a chart properly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can seem useful. Even if it's not your primary method of trading, technical analysis relies on the price that is on a chart you are using. Most charting systems will allow you to add technical analysis tools to overlays on your charts, as well as showing, now trend lines, as well as showing direction and strength of the current price movement. Trend lines also shows potential support and resistance. The future support and resistance of the current price movement are very valuable pieces of information, and there are several trend line trading systems that are based upon support and resistance, like AutoChartist. Okay. Now, trend lines are one of the most basic concepts. Now, trend lines show three distinct but related pieces of information. They show you the direction of the current price movement, as we've been looking. It also shows you the strength, or the more precisely, the speed. As you remember, when we were looking at the oil, okay, we could see how steep that trend line is. When we were looking at the pound, it was a horrible weak trend, and it didn't have any depth to it. So it was on a very low angle, so therefore it didn't have much speed. It also helps us see future support and resistance levels of the current price movement. These pieces of information can be used independently of each other, or they can be used together as part of a larger trading system. But no matter how you're going to trade, if you're a fundamental trader, if you're a guessing trader, if you're a technician, okay, if you're using some type of an automated system, you need three pieces of information on your charts anyway. Okay, and these aren't three pieces that really give you, they don't have any predictive quality. You need trend lines, volume, and support and resistance. And the three together can actually form a trading system, because there is a relationship between a trend line and volume. Okay. Because when a trend is moving up steadily, volume should remain even. Volume is the blue line is the amount of contracts or the amount of stock being bought over a period of time matching your charts, and is located on the bottom of your charts. When you're in an uptrend, your trend line, your volume line, should stay consistent with that uptrend. If volume starts to deteriorate, it's telling you that trend is about to lose its legs. If volume starts to accelerate, it's telling you more and more people are believing in that trend and pushing it farther. And this will help you start using things called breakouts. Breakouts are when, the concept of breakout is relatively simple and requires very moderate understanding of support and resistance. Support and resistance are the next lines we put on our charts. Support and resistance are very important, because generally breakouts are used when a market is already at or near extreme high and lows of the recent past. The expectation is that the price will continue moving with the trend and actually break the extreme high and continue. With this in mind, to effectively take the trade, we simply need to place an order just above the high or just below the low, so that you can trade automatically, so your trade automatically gets entered when the price moves. These are called limit orders. And in order to start predicting retracements, breakouts, continuations, reversals, you need to be able to put your trend lines on the charts. And then we have, like I said, we have a whole class in trend patterns, and we'll go over breakouts, retracements, reversals. And what you have to do is you have to understand the difference between a retracement and a reversal, because a retracement is simply the price retracing it over a short period of time while it's consolidating to go return back to its trend, where reversals are telling you that the price is now reversing and going from an uptrend to a downtrend. And all of this is based on being able to put your trend lines on charts and technical analysis, and the next step by adding support and resistance to your technical analysis charts. So All of this is predictable, but you have to first start understanding how to draw your trend line. Now, the best recommendation I can give you, especially if you're going to come to class, is if you missed our charting basics class, wait for us to give it next month and come to that one. Then you pick, what my suggestion is, pick one asset, whatever asset you like, one asset. If you're not doing charting now, and start looking at the chart several times a day for that asset. Start drawing your trend line on there. Start to watch price movement. Start to get familiar with that asset and the personality of that asset, and then come to each class and we'll get you the trend lines on there. We'll get you up to adding volume and support and resistance. And before you know it, you've got all of this information on your one chart. Then you can simply use it on all charts, but just take one and get familiar with it. Excuse me. And we'll take you over to that. So the next class that's important is called support and resistance. But I want to take you back over to the live chart, real quickly, and show you where you would find volume to use in conjunction with your trend. So let me pop up the charts again. And see down below here, this is volume. And we just add volume to our charts like we do any other indicator. And what we want to do is, as price is moving up here, what we're looking for is to see a steady, a steady relationship between volume. So here, the uptrend started, we have a steady relationship here. Then we had this surge in price, and look what happened to surge in price. We see volume escalating. So that means the traders are becoming very supportive of this and pushing the price up. Okay. Then we see price ease down, and we see the volume tipping down here towards the end. Now we're right at the current markets. But you need to see this relationship between price movement and volume. It can tell a story with the trend line very well, because when you see volume change while a trend is happening, it's telling you either if it's reversing itself and getting very low, traders are starting not to believe in that trend. If it's getting very much stronger, the traders now here were starting off the trend and they were waiting to see if it really got established. At this point, they started pushing that trend, and more buyers were entering the marketplace, pushing the price up. So thank you very much for joining us tonight. Hopefully I'll see you we have a whole bunch of new classes coming up in March. February is almost over yet. And hopefully I'll see you in our class on support and resistance. I'll see you in our class on basic charts. And the March schedule should be posted in a day or two, so keep an eye on it. And thank you very much for being part of the ETX family. Have a good night now.